Hello and welcome back to Principles of Accounting 2. I am your host, Dr. B. Today we're going to be talking about decentralized operations within accounting and what that means for businesses. So before we jump into decentralized operations, I want to quickly discuss and recap where we are in our course together. We are in week 6. This is an 8-week course in theory, although the 8th week is reserved for the final exam. So today we're going to be covering chapters 24 and 25 in great detail. Today is our last WebEx session. Now you're probably wondering, well, Dr. B, what's going on? Well, this week you have your chapters 24 quiz and chapter 25 discussion board. What's happening next week, week 7? Week 7, you have your chapter 26 quiz, chapter 27 homework, chapter 28 discussion. Oh my goodness. That's a lot. Absolutely it is. Chapter 27 and 28 will not be on the final exam. Chapter 26 will be. I'll say that again. Chapters 27 and 28 will not be on the final exam. Chapter 26 will be, to some degree. There's like 2 questions on it. I would still like you to complete the chapter 26, 27, 28 assignments because, yes, they're worth points. However, you will not be tested on chapters 27 and 28 on the final exam. Next week, instead of hosting a WebEx session because it is finals week plus, I say plus because our final exam is on May the 4th. My goal, what's going to happen is that instead of having the WebEx session for next week, the videos for each chapter will be posted on Monday morning. In fact, they're already on our YouTube channel, but I will post those on Monday morning. Or I could even post them earlier this week if you like. It's up to you. But the overall point is today is our last WebEx session together. We'll cover chapters 24 and 25 today. Chapters 26, 27, and 28, there will be a video posted for those chapters. Chapters 27 and 28 will not be on the final exam. You're probably wondering, well, Dr. B, why aren't we being tested on 27 and 28? Those chapters are very simple, very, very simple. They are very straightforward chapters. There's not much to be tested on for 27 and 28. The reason why I say that is because they're qualitative in nature. 28 talks about corporate social responsibility. 27 talks about capital investments. The reality is with 27 and 28, there's just not much content to be tested on. So that's why they're not going to be on the final exam. So the final exam will cover chapters 22 through 26. So good news there, it's only a few chapters, 22, 23, 24, 25, 26. So it's only 5 chapters that will be covered on the final exam. That's the good news. The final exam is open and available now. So if you're interested in find out what's on it, go ahead and open it up. Take a look. There's 20 questions on the final exam. What does that mean, 20 questions? That also means that it's worth 20 points. 20 points in this course means it's worth 20% of your total grade. Okay, that's a lot. It's a lot. That's 2 full letter grades just in the final exam. So my recommendation for your success in this course is the following. For this week, my recommendation, my strong recommendation is for you to complete Chapter 24 quiz, Chapter 25 discussion board. You might want to even go ahead and try to complete Chapter 26 quiz, Chapter 27 homework, Chapter 28 discussion board as well. Definitely work ahead. That is my recommendation. Work ahead, work ahead, work ahead. Because this week we have the Chapter 24 quiz, Chapter 25 discussion. I would like to have you also complete 26 quiz, Chapter 27 homework, Chapter 28 discussion. Reason why I'm asking you to work ahead is because the final exam is also going to be due May 4th. It is open and available. The exam is open and available. So if you are one of those individuals that wants to work ahead, wants to get everything done as quick as humanly possible before your other courses have their exams, do it. Absolutely do it. In fact, I encourage you to do it that way. I think it'll be beneficial. Any questions, any of that?
I have a question, Professor.
Travis, go ahead.
How many attempts do we have at the final?
Just one. Just one.
Okay.
There's only one attempt on exams in
And
this course.
is there a time limit?
No time limit. Absolutely not. Time limits are too stressful, Travis.
I agree. That's why I asked. My other professors had time limits on their finals as well, so I was just asking. Thank you.
Yeah, I'm one of those. I'm one of those people that I think that time limits they induce a lot of stress. They induce a lot of anxiety, and
Yeah.
that's why I don't like them. So, so yeah. So to go along with what Travis had just asked, if there's no time limit, you can start it now. You can save your save your responses, close it, and return to it. It is open book, open note. It's available now. You have until May 4th to complete and submit it. It's 20 questions, open book, open note. You have until May 4th. What does that mean? There's no reason why you shouldn't get full 20 points. The questions are multiple choice, true, false, matching. Covers chapters 22, 23, 24, 25, and 26. The exam does not cover chapters 27 and 28. Excellent question, Travis. Thank you so much. Any other questions on what we just talked about before we jump into today's lectures? We're good? Okay. All right. Well, if you think of anything, just go ahead and let me know. You have my email address, my phone number. You can set up office hours, whatever you like. Okay, I'm here for you. All right, let's jump into Chapter 24, Evaluating Decentralized Operations. The idea behind decentralized anything means that it's not centralized in simple terms, right? A centralized business means that all of the decisions are made at the top level. Okay, the CEO, board of directors, they make the decisions at the top level. It's centralized. They delegate it down to lower levels of management, who then delegates it to the employees. That is a centralized operation. A decentralized operation gives responsibility to the individual managers that are responsible for their respective divisions or departments. And they're the ones that have the ability to make decisions. So, looking at it from a graphical perspective, centralized, top management makes all the decisions. In a decentralized focus, top management delegates decision making to the division managers. You could think of division managers as being department managers or managers that are responsible for various aspects of the business. There are a couple advantages and disadvantages of decentralized operations. Advantages of decentralized managers are close to the operations and they're the best people to make decisions because they know the business. Managers provide there's excellent training for managers, allows managers to become experts in their operations, helps to retain managers, and improves creativity and customer relations. All of that to say, the best advantages of decentralized operations is that the managers of their respective departments or divisions have the ability to make decisions, which improves the relationships with customers. And because those managers understand their respective departments. Disadvantages of it is we don't see the whole company picture. What that means is you've got a bunch of individual managers making decisions. They might make overlapping decisions, or they might make decisions that has a negative impact on the entire company's operations. But that's a disadvantage of it. And another disadvantage is, which goes along the lines with the overlapping, is there's what we call duplication of assets and expenses. What that means is different departments might be using the same exact assets and the same exact expenses, and therefore they're duplicating it because the two division managers, they really don't talk to each other. So it's kind of like, oh, the left hand doesn't know what the right hand is doing, and so therefore we're duplicating assets and expenses, which is a problem for the business overall. So some good things about it. It's mostly good. It's mostly good from that perspective. I personally like decentralized businesses. So how do we account for decentralized operations? The managers of each division or department has the responsibility for managing that department or division. And along with that responsibility comes this thing called responsibility accounting. And what that does is it measures the income and the the revenue and the expenses and the profits and the assets for each department or division. So what that means is the manager of the division or the department is responsible for managing the revenue, expenses, and assets for their respective department. Okay? And so within responsibility accounting, basically what we're saying is the accounting is for each individual department or division. And we think of each individual department or division as being what we call a responsibility center. Responsibility center. Okay. And within responsibility centers, they are classified as either being a cost center, a profit center, or an investment center. Cost centers are responsible for costs. Profit centers are responsible for revenue and costs. And investment centers are responsible for revenues, costs, and assets. So when we talk about responsibility accounting, responsibility centers, and managers that are responsible for making decisions within their respective departments, we're looking at how managers make decisions within those respective departments. Earlier I'd said that the responsibility centers or departments are classified as either being cost centers, profit centers, or investment centers. Cost centers are responsible, cost center managers are responsible for managing and controlling all of the costs associated with that division. So when you hear the word cost center, think they only manage cost. That's it. They're not worried about revenues. They're not worried about profits. They're not worried about investing. They're only concerned about cost. Looking at an example, this is a good example, right? Think of a university. A university is a business. Within that business, the university has a couple of different departments or colleges, right? And within each college, we have departments. So think of it this way. UDC has a lot of different colleges. College of Business, College of Art and Sciences, College of Engineering, the community college. We're in the community college. Within the community college, we have the Department of Business, Department of Accounting, Department of Education. There's a lot of other ones, as you know. Within each respective department, there's a department manager. So if you think of my responsibility, my course, you all know that I teach accounting courses. I'm responsible for the accounting program here at UDC's Community College. And so my department is the Department of Accounting within the community college within the university. My accounting department that I oversee, I'm responsible for all of the costs associated with running my program. So it just kind of shows you the levels, right? It's on the university is the highest level. Then we have within the university colleges. Within the colleges, we have departments. And I'm responsible as within the department. I'm responsible for all of the costs associated with my department, and I manage all of my costs within my department through budgets, which we talked about in previous chapters. Think of actually, was it last week? I think, right? We talked about budgeting. Yeah, that sounds right. Yeah, I think it was last week. When we talked about budgeting last week, we talked about this thing called the master budget. Master budget is comprised of smaller department budgets. Okay. Uh, so, in looking at this slide, we see how each department is represented as a responsibility center. So, for example, let's say my accounting department is Department 1. Department 1 belongs to the community college, which is Plant A, we'll say. And within my department, I have my profit and loss statement or my income statement. And on my income statement, I have expenses. And we can see how all of that is broken out. And on the right side, we can also see the personnel that's responsible for each area. So I would be supervisor for Department 1. Above me would be the dean for the community college. And above the dean for the community college, you would have the president of the university. So that kind of shows how everything is aligned. Yes. So that was cost centers. Profit centers, which is a different type of responsibility accounting, right? Profit centers are responsible for both revenue and expenses, or revenue and cost. And the profit center managers are responsible for managing the revenues and the costs. Well, of course, and profits. That's how we get profit. You know that. You know, revenue minus expenses equals profit. Right. So think of it this way. The profit center, you want to think about the income statement. Think of a profit center as an income statement. The manager is responsible the manager of the profit center is responsible for the income statement of their respective division or department. You'd even break it down into products, really. I mean, you get really granular with this stuff. And so it's really based off of the income statement. So anytime you hear profit center, think income statement, revenues, expenses, operating income, which is profit. On the income statement, we know that we have revenues and expenses controlled by the manager. We call these controllable costs. Controllable. When you hear the word controllable, it's within their control. In other words, I can control my revenue. I can control most of my expenses. Not all, but most. Like I can't control what the rest of the company does in terms of expenses, right? I can only control my department expenses. So when you hear controllable, it means that that manager of that center or that division, they can control those expenses. Oh, you know, I can adjust my labor expense. I can adjust my materials expense. I can adjust my variable costs. But I cannot control factory overhead. Okay, cannot control factory overhead. That's factory overhead's the business, the company controls that. The individual manager of a department, some of those things cannot be controlled, especially for fixed costs. Okay, so we talked about cost centers, we talked about profit centers. Within profit centers, as you know, are concerned about revenues, expenses, and profit. Within the profit centers, we have expenses that are considered to be what we call service expenses. Service expenses. Every business has what we call a service department. I guess you could call it the service department. Think, when you hear the word service department, think providing a service to the business. They don't interface with customers. Human resources, advertising, legal, accounting, transportation, telecommunications, they all provide services to the business. They provide services to the business. That's why I call them service departments, because they provide services to the business. They're not responsible for profits because they don't have any revenue. The legal department doesn't have revenue. That's an expense department. It's a service department. Advertising department doesn't have revenue. They have advertising expenses. Human resources doesn't generate revenue. They are a service department. So when you think service department, think they support the overall business through expenses. And they are a part of the profit center because they're expenses, right? Service department charges are indirect expenses to the profit center. Service departments, again, they provide services to the business, and they are thus called service departments. They have allocations where they are assigned to the various profit centers based off of their usage. What does that mean? Okay. Think of think of a department store. You got like what Macy's, okay? You got Macy's. Macy's has women's clothing, men's clothing, children's clothing, jewelry department, homewares department. I'm sure there's a bunch of other ones, right? Each department has similar functions. You have Department managers, they generate sales, they generate expenses. You know, they each have labor, they each have cost of goods sold, they each have other expenses, right? With service departments, they provide services to every department within that department store. So, for example, the accounting department of Macy's does not just provide accounting services to the women's clothing department. They provide accounting services to all departments within Macy's. That's why they are a service department. The same can be said with, of course, human resources. They provide human resources services to all departments. Same with legal. They provide legal services to all departments. The allocation of expenses generated from these service departments are allocated to the profit centers, also known as departments. They allocate the expenses to the profit centers based off of their usage by each service department. What that means is, let's say the men's clothing department in Macy's is hiring for more people to help in that department. Okay, so they'll work with human resources to hire someone or individuals to fill those empty roles. What happens is, once those roles are filled, human resources will bill the men's department based off of the usage from human resources to fill that role, the cost of posting the job and hiring someone. And that's how it works. That's how the hotel business works the same way. So you think about the hotel business, you have front of house, back of house, you have housekeeping, you have front desk, you have banquets, restaurant, sales department, uh, you name it, right? The hotel also has human resources, accounting, legal, all of those various service departments. When the hotel is looking for housekeepers, right, uh, human resources will deduct the cost of the listing and the cost of acquiring a housekeeper to the housekeeping department's budget. That's basically what this means. Does that make sense? Are there any questions around that? Awesome. Thank you so much. Okay, so let's look at it from a fun example. I like this example. It's one of my favorite ones. Uh, okay, so pretend Disney is really small. Okay, we know it's not. We're Disney. Disney. Disney is an entertainment company. We have two different divisions. Disney has theme parks and movie production. Disney has theme parks and movie production. Within Disney, I have theme parks and movie production. Now, I have revenues and expenses for both the theme parks and the movies. My theme park revenue is $6 million. My operating expenses is $2,495,000. For my movie division, I have $2,500,000 revenue, operating expenses $405,000. Okay. In accounting, we know we have things called direct revenue, direct expenses. Direct expenses include wages and salaries of a division employee. We also have our service departments. We have purchasing, payroll, and legal. These are service departments for the entire Disney company. We have purchasing, 400,000 expenses. Payroll, 255,000 expenses. Legal, 250,000 in expenses. Total expenses, 905,000 just from our service departments. Think about activity-based costing now. Put your activity-based costing hats on. So activity-based costing tells us that we use cost drivers associated for each activity, right? Within purchasing, it's the number of purchase requisitions. Within payroll, it's the number of payroll checks issued. Within legal, it's the number of hours billed. So what we need to do is find our service usage. The theme park used 25,000 purchase requisitions. They issued 12,000 payroll checks, and they were billed 100 legal hours. For movie production, we had 15,000 purchase requisitions, 3,000 payroll checks were issued, and 900 legal hours were billed. That gives us 40,000 total purchase requisitions, 15,000 payroll checks issued, and 1,000 legal hours were billed throughout the year. And this follows the same type of allocation we talked about when we talked about activity-based costing, and we also, I'm sure you remember the discussion we had around how we find the factory overhead rate. Remember that? The single plant-wide rate method? Remember when we talked about that? It's the same type of approach. Same type of approach. We to find how the individual cost per unit, when we talk about the support departments, we find this thing called the support department allocation rate. So to do that, we take the total support department expense for each department divided by the total support department usage. That makes sense. So for purchasing, we said we had a total purchase department expense of 400,000. We issued 40,000 purchase requisitions. So you take 400,000 divided by 40,000. It's $10 per purchase requisition. Makes sense. For payroll, we used the total payroll department expense was 255,000. We issued 15,000 payroll checks throughout the year. That got us to $17 per payroll check. That makes sense. That's about the going rate. And the legal allocation rate, we were billed a total of $250,000 from legal. We used 1,000 legal hours. That gives us $250 per hour for the legal department. Also, that makes sense. That's about right. So looking back at our usage, it's very simple to find out the usage for each division. You simply take the number of units used, in this case purchasing 25,000, times $10 per requisition. Give you an idea. But we'll talk more about that right now. We take the service usage times the allocation rate. So for purchasing, we had 25,000 purchase requisitions for purchasing for the theme park. At $10 per requisition, that's $250,000. For payroll, the theme park issued 12,000 payroll checks for the year at $17 per check. That's $204,000 for payroll. For legal, we were billed 100 hours at $250 per hour. That's $25,000. The total support department expenses for the year for the theme parks was $479,000. So when you're thinking about the steps, right? First, you get your data. We're just going back a little bit. First, you get your data. First thing you find out is what was the total expense for each support or service department. Then we find what was the total usage for each service department. Once you find out what is the total expense, what is the total usage, you can find the rate. Total department expense divided by total department usage gets you per use. Okay, per use. Also known as service department allocation rate. Per use. Once you find your per use, you take your service usage times per use, or total support department allocation rate, to get you your total allocation for each service. Just a matter of following those steps. Gather the data, find the support department allocation rate, then find, step 3, then find the support department allocation. You do those 3 things, it'll be very, very simple for you. Okay. How do the reports look? It's very similar to the income statement. For the profit center reporting, it's very similar to the income statement. It's like having a budgeted income statement, actually. As you would normally do, we compare our budget to our actual performance over time. Right? We learned a lot about that when we talked about budget. However, this is a big however. When we compare our actual performance to our budget, we do not want to compare one department to another. We compare actual budget for the department. We compare the budget for the department to the actual performance for that department. We're not comparing one department to another. We're not comparing one center to another. That doesn't make sense. You would never compare one center to another because they're going to have different revenues. They're going to have different expenses. So Disney is never going to compare their theme parks to their movie production. They're totally different. They have different revenues. They have different expenses. They have different operating income. But this is how the profit center statement looks. The income, it's very similar to the income statement, as you can see. We have our revenues minus our operating expenses equals our operating income before service department allocations minus our service department allocations equals our operating income. It follows the very same format that an income statement has. The difference here is that we break out our support departments. Revenues minus operating expenses. Then you get your subtotal minus your support department allocations. Then you get your operating income. Very, very similar process. So we talked about cost centers. We talked about profit centers. Now we need to talk about investment centers. Investment center managers are responsible for costs, revenues, profits, and assets. Okay. When you hear the word investment center, think they're responsible for everything: revenues, expenses, and assets. Revenues, expenses, and assets. Assets, property, plant, and equipment. Property, plant, and equipment. So this investment center managers are responsible for revenues, expenses, and property, plant, and equipment. They're responsible for property, plant, and equipment from the perspective of, and these are new terms, okay? Return on investment and residual income. Let's talk, and we're going to talk about return on investment and residual income here in a second. Look at the income statements. This is another example, looking at this income statement. Here we go. This is consolidated, yes? Revenue minus operating expenses equals operating income before service department allocations minus service department allocations equals operating income. Well, it's the same exact process as your standard income statement. Okay, return on investment. The idea behind return on investment is that when the company decides to utilize the assets that the company has to generate income, it helps the company to understand their potential to make profit. Okay. So in other words, the company decides to purchase assets to generate revenue, right? That's the whole idea. If I'm a manufacturer, I need to purchase a building, I need to purchase equipment, okay? This ratio tells me how well I am using or utilizing my assets, property, plant, and equipment, to help me to generate income or revenue. So it's a very straightforward formula. We have operating income divided by invested assets. Now I can already hear you, Dr. B, what are invested assets? Invested assets are the assets used to help the company to generate revenue. Okay, typically it includes property, plant, and equipment. Let's take a look at an example. Our company, Data Link, we provide data services and we sell devices. Okay. Our company has 3 different divisions: Northern, Central, and Southern. We have invested assets: 350,000 North, 700,000 Central, 500,000 South. We have operating income for each division. Northern is 70,000, Central is 84,000, Southern is 75,000. To find the formula, you take your operating income divided by your invested assets. For the Northern division, it's 20%. Operating income 70,000 divided by invested assets 350,000. You do the same thing for each division. Okay. 20% for the Northern Division, 12% for Central, 15% for Southern. What this tells me, what this data tells me, is that the Northern Division is effectively using their invested assets to generate the most profit. 20%. The higher the ratio, or the higher the percentage, the better. Okay. What this tells me is that the Northern Division is utilizing their assets the best. Next will be Southern and then Central. You're saying, oh, Dr. B, though, we see that the operating income for the Central Division is the highest. How is it possible that they have the lowest percentage, the lowest return on the investment? Well, that's because they have a lot of assets, but they did not utilize all of their assets wisely to generate the revenue. 84,000 divided by 700,000 is only 12%. We see that when you compare their invested assets to the Northern Division, it's like, yeah, the invested assets are smaller in the North, but they were able to utilize those assets more effectively. That's basically what return on investment tells us. To understand return on the investment, there are a couple of other formulas in finance that we talk about in order to understand how well the company is using their assets. This other one's called the DuPont formula. Okay, it's relatively complex, so we'll go slowly through it. DuPont, yes, it's the paint company. It was founded in the mid 1800s. DuPont Paint, DuPont Chemical. It's a very old company. It's been around for a very long time. They wanted to find a way to understand how well they're utilizing their assets. So the president of the DuPont company at the time, back in the 1800s, came up with a formula to use to understand if the company was utilizing their assets the best. Turns out that formula worked out so well, it was adopted by pretty much everyone in the finance world. So DuPont formula helps to analyze the utilization of assets across different divisions. There are two components of the DuPont formula that we look at. One is called a profit margin, the other one is called investment turnover. Profit margin measures operating income to sales. So if you think about your income statement, you have revenue at the top, which is sales, and you have operating income at the bottom, okay? Or almost at the bottom, before some of the expenses, right? That's your profit margin. And I'll show you how to calculate that. We also have investment turnover, which is how quickly, this measures how quickly I'm selling my invested assets or my inventory. So let's talk about it. To calculate profit margin, you simply take your operating income divided by sales. That's it. Profit margin is operating income divided by sales. Investment turnover is sales divided by invested assets. Okay. To find the DuPont formula, we take the profit margin times the investment turnover. So operating income divided by sales, then I do sales divided by invested assets, and once I've found both of those figures, I multiply them together. You get the DuPont formula. This type of formula helps me to better understand my overall profits, how well I'm utilizing my assets, and how quickly I am selling my inventory. That's what this DuPont formula tells me. And I can compute this across my various divisions. It also helps me to evaluate my divisions, comparing my divisions from one to another. The return on investment, profit margin, investment turnover are all interrelated. And these formulas, these ratios, helps me to better understand if my assets are properly being utilized. So let's put the DuPont formula to work in our example. Operating income divided by sales, 70,000 divided by 560,000 in the Northern Division. Sales divided by invested assets, 560,000 divided by 350,000. I multiply those two together, I get 12.5% for my profit margin. 12.5% profit margin, and I have investment turnover at 1.6. 12.5 times 1.6 gets us to 20%. Okay. You're probably thinking, no, Dr. B, that 20% looks real similar to what we were calculating earlier. It is. It's the same, actually. This DuPont formula is the same, or very similar, I should say, to our initial return on our investment formula. Because what this does is it helps us to better understand how well I'm utilizing my assets. That's why we calculate it this way. Okay. Oh, yes, the profit margin. When we have a change, we compute that difference as well. So we have an example here. Our Northern Division ran a TV advertisement. Okay. Ran a TV advertisement. They ended up generating an additional $56,000 in revenue by running a TV advertisement that cost $385,000. I know it's expensive. So we had generated an additional $56,000 revenue from running a TV ad that cost $385,000. So what happened here? Of course, that's going to change our formula. We have $616,000 in revenue, so the original 560. We have an additional $385,000 in operating expenses. So revenue minus operating expenses equals operating income before service department allocations minus service department allocations equals operating income, $77,000. We plug that into our DuPont formula. Operating income, $77,000 divided by sales, $616,000 gets us 12.5%. 12.5% is our profit margin. Then we have sales, $616,000 divided by 350,000 in our, what am I trying to say there? Gets us to 1.76. That shows a 22% increase on, so that's a 2% increase on our return on investment. Questions? A couple of hands raised.
Yeah. So I'm a little confused on the DuPont formula. If we're using the sales,
yeah,
and both the numerator and the denominator, effectively taking the same formula and multiplying it times 1, it's the exact same thing mathematically.
No, well, kind of, yeah. So if we look at the return on the investment DuPont formula, we're taking our profit margin times investment turnover. So, in other words, the DuPont formula kind of combines two different methods of return on investment. Profit margin measures return on investment. Investment turnover measures return on investment. So, with the profit margin, operating income divided by sales to find profit margin, Investment turnover is sales divided by invested assets. We have the sales represented in both of these formulas because in order to find profit margin, you need to know what your sales are. In order to find investment turnover, you need to know what your sales are. So it's just really the positioning more so than the having it in both places, if that makes sense.
I mean, kind of. Sorry, I'm kind of nerding out on it because I used to be a math major. So basically, this formula to me is the same thing as operating income over invested assets.
Yeah,
Because if you take the sales, they eliminate each other on mathematical principles.
You're correct. You're correct. From a mathematical principle, absolutely. And that's, and in theory, operating income divided by invested assets is the return on investment. We talked about that, right? So operating income divided by invested assets is return on investment. Well, the reason why we separate this out the way that we do with the DuPont formula is in order for us to see what the profit margin is and what the investment turnover is. The overall purpose of the DuPont formula really is to, of course, see profit margin, see investment turnover, but also to help us to analyze the difference between different divisions. So Dylan, the way to think about it is the DuPont formula helps us to rank our divisions.
Okay.
It's the best way to think about it.
Right.
But I agree with you. I mean, it's just simplest to take the operating income divided by invested assets because ultimately you still do derive the same percentage. So it's just kind of going the long way around. Excellent observation.
Thanks. That helps clear it up a little bit.
I'm sorry?
I was just saying thank you for the answer.
Oh, of course. Yeah. Anytime. Absolutely. Travis, did you have a question as well? Or maybe the hand's just still up? Yeah. You're okay. All right.
No, sir, I'm good.
Okay, got you. No worries. Thank you. Okay, cool. So yeah, a 2% change based off of a $56,000 increase in revenue and a increase in expense of $385,000. So, and again, we would use the same ranking method using the DuPont formula to then make a decision whether to accept or reject. So, what does that mean? You can use the DuPont formula also, in addition to ranking divisions, you can also use it in order to make decisions on investments. So the decision here was, do we take out a TV advertisement that cost $385,000 for a $56,000 increase in revenue? We know that would change our DuPont formula return on investment by 2%. Is that 2% change enough for a decision to be made on this type of change? Maybe. So the disadvantage of ranking using the DuPont formula is that it leads to the potential for a division manager to reject a new investment that could be profitable for the whole company, although it may reduce that respective division's percentage. So looking at this example, we have a current return on investment of 20% for the Northern Division. Management's minimum internal rate of return or acceptable investment is 10%. The expected return on a new investment project is 14%. Just given this data, the division manager may decide to reject this new investment for this new project because of the fear that the division's return on investment would reduce from 20% to 14%. Although the minimum acceptable investment by management is 10%, 14% is higher than 10%, so it'd still be above the minimum, but management might still decide to reject it because it would decrease their average, their return on the investment. So it's interesting. It's interesting in those types of decisions. Would I do the investment? Maybe. I probably would. I probably would, because it's above the minimum acceptable, right? To that regard. Which leads us to our next discussion, is this thing called residual income. Residual income is what I like to call the additional income, right? The additional revenue. Residual income is the excess operating income over the minimum acceptable income. Residual, that's what the word residual means. It means additional, or a benefit of additional revenue. Residual income. To find what is the minimum acceptable operating income, we take the company's minimum return on investments and we multiply that by the invested assets, and that sets our minimum. To find residual income, we take our total operating income minus the minimum acceptable operating income as a percentage of invested assets equals our residual income. Looking at our divisions, focusing on the Northern Division, we have operating income of $70,000. We have a minimum acceptable operating income of $35,000. How do we get $35,000? Well, we have invested assets of $350,000 for the Northern Division. We multiplied that by 10%. Why 10%? 10% is the minimum acceptable return set by management. So 70,000 minus the 35,000 gets us to 35,000 of residual income. Advantages of this residual income is it helps to encourage division managers to maximize operating income. Of course, that's the whole objective of business is to maximize our revenue. And of course, that type of activity will be acceptable. Looking back at our example, current return on investment 20%, minimum acceptable by management 10%, expected return on a new project 14%. This ROI of 14%, while it may not be great for the individual division, it would, however, benefit the entire company for two reasons. One, it would raise the profile of the company. Two, it's above management's minimum internal rate of return, 10%. So I personally would accept the project I think it would be favorable. And it would support the entire company and not just the division. So that leads us to our next part of the discussion. It's pricing. Pricing, we talked about minimum rates of return. We talked a lot about several different things, right? Oh, my apologies. When we were talking about residual income and ROI and all those awesome things, we need to also understand pricing, how pricing works. When you have more than one division, we discuss the idea of pricing as it relates to each division. One division might need more product than the other. One is selling at 100% capacity, one's at 80% capacity, and the one at 80% capacity needs additional inventory to sell. What do? We transfer the product from one division to another. It's not that simple. You can't just send inventory from the Northern Division to the Central Division just because the Central Division needs it. There's a price, there's a cost associated with that. It's called transfer pricing. Transfer pricing is a concept that there's an additional price associated with the transfer of inventory from one division to another. And transfer pricing can be set in three different ways. One's called the market price approach, the other one's called negotiated price, and the third is called cost. The idea behind it is that the two division managers agree upon a price that is transferred from one division to another. With transfer pricing, it can be set as low as the variable cost per unit, also known as the cost approach, and it can be set as high as the market price. Market price is the price that would be paid on the open market for that product. And oftentimes, the division managers set a price in between the variable cost per unit and the market price. So let's take a look at our company. We have Wilson Company manufacturing basketballs in both the East and the West. In the Eastern Division, sales is 1 million, Western Division 800,000. The Eastern Division sold 50,000 units at $20 per unit. The Western Division sold 20,000 units at $40 per unit. Variable costs in the East were $10 per unit. Variable costs in the West are $30 per unit. The reason why it's $30 per unit in the West and only $10 in the East is that in the West, $20 of that 30 is represented in material costs, and the other $10 is represented in variable conversion expenses. The variable conversion expenses are a result of transfer pricing. Using the market price approach to transfer pricing, we look at how much it would cost for an outsider to buy the individual unit. That's what market price is. It's the cost of the product on the open market. And that would be set as the transfer price, which is super high. There's no way I would ever pay market price for a transfer price, but that's just me. Okay, so if the market price, let's go ahead and take a, going back to our example. Let's say that in the East, let's say the Western Division needs more basketballs. And so they approach the Eastern Division and say, hey, I need some more basketballs. You have a lot of them, and I need some more, right, to sell. So the Eastern Division says, you know what, I'll charge you market price to transfer the basketballs to the Western Division. The market price is this current sales price. There's your 20 bucks. So what happens in this case is that instead of the variable cost per unit of being $10 in the West, the variable cost becomes $30 in the West. The $20 is represented in the transfer cost. We call that conversion cost when that happens. So we assume that the Western Division is currently purchasing basketballs at $20 per unit from the East using the market transfer price approach. The Eastern Division is at full capacity of 50,000 units, but they can sell the additional units to the Western Division. If they sell the additional units to the Western Division at market price, it'll be $20 per unit. That would give the $20 of conversion costs added to the Western Division's $10 variable cost per unit. And as I said earlier, the market price approach is probably the most expensive way to do it, any type of transfer pricing. So what typically happens is that there's negotiation between the two division managers. So the Eastern Division manager and the Western Division manager negotiate a price. This is typically a price in between the variable cost and the variable cost, which is the lowest cost, and the highest cost, which is the market price. So low is variable cost, high is market price when we talk about negotiated pricing. So the variable cost per unit is $10. The market price per unit is $20. In order for the two to negotiate a deal, they typically meet somewhere in between, right? You can see where we're going with this. So using the negotiated price approach, managers agree on a transfer price. Transfer price is between the market price and variable cost per unit. Variable cost per unit in our example is $10 per basketball. The market price per unit is $20 per basketball. If the transfer price is in between $10 and $20, we can already imagine the transfer price is probably going to be about $15 per unit. That's what that tells us. It's really that simple. But that's a whole idea between that's the whole concept between a negotiated transfer price. Is the two managers get together and they agree upon a transfer price. So the variable cost per unit is $10. The market price is $20. The transfer price that was negotiated upon is going to be $15. It's in between the market price at the high end and at the low end, the variable cost per unit. And so what this represents is the change. What will ultimately be the change in operating income when that happens? Well, we have a transfer price minus variable cost per unit. $15 minus $10 is $5. times the number of units transferred. Our example, 20,000 units were transferred. So $5 per unit times 20,000 units gets us to 100,000. So the formula to find the increase in the operating income, take your transfer price minus your variable costs. Do that first, order of operations, right? Parentheses, times the number of units transferred. Our example giving us to 100,000. And this kind of shows us how that change works. So remember, when we talk about negotiated pricing, variable cost per unit is the lowest possible price. The highest possible price is the market price. And in between is going to be the negotiated transfer price. And that's the best way to think about it. So, and to find the change in operating income, you take your transfer price minus your variable cost per unit, do that first, and then multiply it by the units transferred. That gets you your change in operating income. The negotiated price provides each manager with an incentive to negotiate for the transfer. It's the most efficient approach to transfer pricing. The third approach is called the cost price approach. And in this, we typically just take the total product cost per unit and the variable cost per unit. So total product cost per unit, direct materials plus direct labor plus factory overhead, which we've been talking about all semester, right? Direct materials, direct labor, factory overhead equals the total cost per unit. We include those in the transfer price. The only thing we do not include in the transfer price is fixed factory overhead, because that's for the whole company, right? Actual costs are standard budgeted costs in this approach. And so there's very minimal incentive for this approach because it's just simply transferring it at product price. But it's probably the most commonly used, especially for larger organizations. Last concept we'll talk about for this chapter is called the franchise operations. A franchise is the right or license to use a company's name, basically. So think of McDonald's. McDonald's is a franchise business. What that means is each individual McDonald's throughout the United States and throughout the world for that matter are individually owned by local owners. Okay? They all have the same name, McDonald's, on the door. They all sell the same exact products. They all have the same exact services. They pay McDonald's corporate office a franchise fee in order to use their name and their product and their service. The same is said in the hotel business. For those of you, my hotel friends, I know a lot of you are in the hospitality world. Marriott, classic example of Marriott hotels. Marriott hotels, the vast majority, not all of them, but the majority of them are franchise businesses. You'll go in downtown DC. You'll see Courtyard Marriott. You'll see full service Marriott. You'll see every other type of Marriott, right? So many different brands that they own. They're all franchise. They are not owned by Marriott. They are owned by local hotel operators. They just so happen to pay Marriott to use the Marriott name. And they also pay for their reservation system and for other things that Marriott provides them with. This is called a franchise. That's a franchise business. There are two entities to a franchise, the franchisor and the franchisee. Franchisor is the entity that provides the franchise. Marriott is the franchisor. The franchisee is the individual hotelier, the individual person flying the Marriott flag outside of their building. It's the franchisee. The franchisee pays a franchise fee to the franchisor. And in addition to a flat fee, they typically pay percent of revenues. Percent of revenues. In the hotel business, and I know this for a fact because I was a financial controller in the hotel business. You guys know that. In the hotel business, we used to have to pay, I was with Radisson Hotels up in New York. Our hotel, we had to pay Radisson corporate office out in Minnesota. We had to pay them a percentage of our revenue. It was usually about 3% of all of our revenues were paid directly to the franchisor, in our case, Radisson Hotels. We also had to pay them for the use of the reservation system. We had to pay them for their marketing. We had to pay them for their music. We had to pay them for their whatever else, right? The list goes on and on. And so that's the model. That's how the model works. A lot of hotels, a lot of restaurants that you think are a major corporation, they're not. They're really not. They're owned by individuals. McDonald's, mostly owned by individuals. Marriott, mostly owned by individuals. Five Guys, mostly owned by individuals. It's another franchise model, exactly. There's so many different models that are franchised. So when you go to them, don't think that you're supporting some big corporation. Most of the time, you're supporting individual families. So franchisors provide them with startup advertising, management development, business systems, supplier relationships, so forth and so on. That's the franchise model. It's a good model. It's a good model. Hilton, another franchise hotel operator. Hyatt, for the most part, they are wholly owned. Go ahead, Richard.
So yes, I wanted to ask about the ownership of the location. Because in the case, say Chick-fil-A, they pick the location for you. So
right.
you don't really own it, you just get a percent of the revenue.
Yeah, great question. So for Chick-fil-A, for example, which I believe most of them are owned by actual Chick-fil-A, but some of them are franchised out. So what happens is sometimes the franchisor will select the property, build the building, put in all the equipment. Basically, that's called a turnkey operation. And what happens in that situation, that's an excellent question, by the way. What happens in that situation is the franchisee has to pay the franchisor, the company, all of those respective costs. So in other words, Richard, what happens is that when Chick-fil-A selected the location for you, the business owner, you have to pay Chick-fil-A the cost of the acquisition for the land, for the building, for the equipment, so forth and so on. They typically build out some type of like loan thing and they roll it all into a loan and you pay back the franchisor that loan over time with interest. So, great question. Great question.
That really helps. Because Chick-fil-A doesn't allow you to have more than one location.
Exactly. Yep. And that's also very common. So some franchisees, they'll have more than one location. Like for example, I know an operator who operates a bunch of McDonald's in one city, and this guy has 5 different McDonald's in one city. Okay, and so, but he still has to pay McDonald's for all 5 operations individually. They're treated as their own enterprise. If that makes sense. Excellent, excellent discussion. So,
Thank you.
hey, my pleasure. So here's an example looking at Hilton. This is in millions, of course. Company operated versus franchised. Some companies, like Hilton, they'll own some percentage of their own hotels, and then the rest of them are franchised out. Marriott does the same thing. A lot of the big names do the same thing. So company operated versus franchise operated. And their income statements look like this. So like if you go to Hilton.com and you find their Securities Exchange Commission 10K report, and you look at their income statement, you'll see this. We'll say revenues, revenues, operating expenses, general administrative expenses, property, plant, equipment, so forth and so on. And we can see ones are owned by the company and ones are owned by the franchises. It's interesting. It's very interesting. And we can run the DuPont model on this type of franchise operation to understand whether it's a good idea to franchise that company or not, right? Because we could get an idea of operating income and revenue and invested assets and figure out what the return on that investment would be. So if Richard was interested in opening his own Chick-fil-A, he can run the return on that investment by looking at the projected income, projected revenue, and the invested assets. He would run out the DuPont formula to find his return on his investment. And that's a very common practice. You can do the same thing with pretty much any business, really. Okay, so that, my friends, is the end of this concept of decentralized operations. Let's go ahead and take a very short 5-minute break. I'm going to stop the recording now, and we'll come back and we will discuss our next topic, which is differential analysis and product pricing. Very important concepts there. So, okay, please go ahead and take a short 5-minute break. Let's meet back here at 12:37.